Good afternoon. This is Craig Modelmog with this week's episode of Wall Street X's and O's. Today is Friday, June 26th. It's hard to believe in 4 days we will be halfway through 2020. It is crazy. I like to kick things off by saying that all of the opinions on this show are mine. They are not a solicitation nor an offer to buy or sell anything. Investments are not FDIC insured. They can and will lose value. And with that said, let's get right into it today. We got a busy show. Month to date here, this is what's interesting. There are 11 different sectors in the S&P 500. As of yesterday, there were 4 that were positive. The positive sectors month to date were consumer discretionary, financials, technology, and communication services sector, which I'm going to call the full bowl on that one, because that one, while it used to be the old AT&Ts and Verizons of the world, now it contains 3 FANG stocks: Facebook, Netflix, and Google. So not quite communication services. I'm not so sure on that. What's interesting is that after the beat down today, the only positive sector is going to be technology. Today was a rough day. This was an interesting week in the market where I think some reality is starting to sink in about really what is really going on. Going to be interesting today, or coming into July, how we continue to proceed forward and handle everything. Top 3 things I'm focusing on: the VIX. VIX remains elevated. We are working on week 18 of an elevated VIX. What is an elevated VIX index? It is a VIX that is north of 26 to 28. Today, the VIX closed at 34.73, up 2.51 or 7.79%. Today was a big volatility day. Second thing on the list is oil. Oil was up 1.3%. As of this morning, or actually as of yesterday. It closed down a little bit today, but what we're seeing is inflation begin to accelerate. Why? We have a government and a Federal Reserve that is printing so much money. What's that smell? Oh, that's the printing press of our government burning. Here's what's going on. They're printing so much money that they're devaluing our currency. Okay, you've seen the US dollar, which has been very strong up till a couple weeks ago, begin to go down in value. Thus, when you have our currency dropping, what happens to prices of commodities? They begin to rise. We're starting to see a little resurgence in commodities that we haven't seen in 10 plus years. They've been dead. Okay, this is something to continue to watch. If we continue to show signs of this stagflation, which is growth decreasing or continuing to decelerate and inflation increase, that is stagflation. You're going to see it in commodities. All right, so keep your eyes peeled on that. Last thing on the thing is high yield spreads over the Treasury. When you look at high yield over the treasuries, the greater that spread is, the more stuff that's hitting the fan. Right now, you're seeing spreads widen north of 6.05%, which is getting to a wider stance. The wider it is, the more bad things happening in the economy, the more challenges that corporations are facing in the United States. 3 main macro focuses. Earnings are slowing. Okay, Nike reported a number today. I think it's their first quarterly loss. They showed revenue was down almost 30% for the quarter, which a lot of it, obviously COVID, everything was shut down. They did have good online sales. I think they're kind of expecting some things to bounce back. But again, we haven't seen a number like that in many years. I think 2011, 2012. What this is a lead up to is what happens as of July 1st. Drum roll, please. Q2 earnings begin. Okay, I think we're going to see one of the worst quarter in earnings that we have seen in the modern day era. It is Friday. Okay. What that means is I think we're going to see some earnings so bad that the last time we will have printed numbers like this, it's going to be depression-like, okay? So this is going to be really interesting and fun to watch. We're seeing bankruptcies accelerate on Wednesday. GNC, if you're a vitamin person, GNC is going through bankruptcy. They're going to close lots of stores. The other one, I'm shedding a tear, Chuck E. Cheese. Okay, parents, if you're parents, don't freak. They're not closing them all down. They're just going through bankruptcy, okay? I have fond memories of Chuck E. Cheese in Wichita, Kansas. CJ and Lizanne, if you're watching this, Chuck E. Cheese, you gotta love it. Pizza's terrible. The games and the ball pit, fun and germ fest. Anyway, in the last, buybacks are collapsing. Really focusing on the banks. I'm going to touch on that as we get into the end of this here. Unemployment, I talk about this every stinking week. Why? Because it's a big deal, okay? Here's what we got. Claims yesterday reported were up. 1.48 million people filed for unemployment claims last week. It was down modestly against an upwardly revised prior week, which was revised upward to 1.54 million. This brings the 14-week total, another drum roll, please. See, Johnny Carson, Jimmy Fallon, you got nothing on me. I'm telling you, this is good. This is bad, but it's good. It's good and bad. I would start doing some Chris Farley impersonations, but then no one would probably follow. I would probably lose the 12 followers I have on my YouTube channel. And like I said, not that I'm trying to make money on this deal, but I like to see my subscriptions grow. Okay, wink wink. Anyway, our 14-week total is 47.25 million people have lost their jobs in the last 14 weeks. Okay, to add to that, PUA claims, again, what those claims are people that are independent contractors. They are 1099 people. They are not W-2 wage earners. We're seeing that really be consistent, where another 767,000 people applied for PUA claims, which has really been flattening out. The last 4 weeks, we've been hovering in that 700,000 per week, which we haven't seen decline much, which you really do not like to see. Okay, that is a real bad thing. If you look at total continued claims, and this is just on the Fed, this does not include the PUA claims or any of that. Okay, is 19.5 million people, which is down just a little bit. I think about 3% week over week. If you add into it all of the numbers, that number is still close to the $30 million people on continued unemployment claims, which is crazy. Okay, on to the banks. Federal Reserve yesterday made a real interesting announcement. They're doing stress tests. If you remember, the big thing back during the financial crisis was the stress test. We're going to look at the banks and we're going to tell you which banks are going to lose all your money or that you're going to have to go through FDIC, right? Here's the deal. In a 4-1 vote yesterday, the Fed decided that they are going to clamp down on a couple things with the banks because they were concerned about, in the event of a prolonged pandemic period, emphasis on that, okay? They were concerned that there were banks that were really not in a really good position from a financial statement. What does that mean? It basically means that they are going to make them freeze on all buybacks. That means banks can no longer buy their own stock back. Side note here, okay? This is where I get a little sarcastic and I'm trying to be funny. So for those of you that you have to have a drink or two to listen to Craig, I'm not going to go that off the wall, okay? I am going to rock a little bit and have a drink of water here. Anyway, here's what's kind of funny. The Federal Reserve is saying, okay, banks, you cannot buy back your own shares of stock because you are not in good financial situation, okay? They're going to review this quarterly. What I find funny or fascinating is that about 6 weeks ago, the Federal Reserve, just a quick recap, said that we're going to open up a facility in which we can buy corporate bond exchange traded funds, okay? That since has transitioned to last week, oh, false alarm, we're not only going to buy corporate bond indexes, we're going to buy individual issues. So with that said, banks, you suck and you can't buy your own shares back, but don't worry, we're going to buy your debt. I know that's a bunch of garbage. Anyway, moving on here. What this also means is that they are also going to have to adjust their dividends. This means that they are going to have to calculate their dividend and only pay out a dividend based on their earnings, which means this could mean a dividend cut for some banks. Thus, financials got freaking killed today. Absolutely killed. Financial index was down 4.5% today. Just an absolute beat down. Okay. So the stress test that they're going to be doing this quarterly going forward. And again, this is in the event of a prolonged pandemic situation or environment. Do you like how I'm doing my fingers? Here's what I find really fascinating, people. The worst is not over. I am not here to be Debbie Downer. You know, I am all about the facts. Funny thing is here, we watch what we want to hear. Okay? I am trying to shoot straight at you. These are the facts that are out there, and we're going to base our decision making when it comes to our investments on facts. Okay? Here's why we are going to be so challenged going forwards. Okay? First of all, the COVID thing is coming back. What I want you to focus on is rate of change. Okay? This is a math problem. This is delta. You like my hand signals? You remember the triangle thing? This isn't a frat deal. I wasn't a frat dude. I used to make fun of frats, actually. So if you're a frat dude, I don't apologize, actually. It's focus on the rate of change. Here's the deal. Leading indicators are people contracting this. They're doing more tests. Thus, people are coming up where we're having more positive tests. Okay? Interestingly enough, policy is being driven on this leading indicator. Testing, contractions, or positive tests are leading indicators. The rate of change you need to focus on are two. One is increased hospitalizations. Two is deaths. Those are lagging indicators, okay? Increased tests, more people contracting. What happens? Increase in hospitalizations, maybe, maybe not. Increase in fatalities. You need to watch those lagging indicators. Those are 2 weeks out, okay? But anyway, so that is what also is coming. I'm equating this to two that now that we're turning the economy back on, it's like you're going through and the government is turning each state on. It's like flipping a light switch. Click, California. Click, Colorado. Click, Kansas. Click, Arizona. Okay? Here's what's going to happen. They're going to get to the 50th light and click it on, and what they're going to find out is the stinking house is on fire. Okay? Here is why. All right? We have a policy cliff. We have multiple policy cliffs that are looming. And you say, Craig, what the heck's a policy cliff? Here's what's happening, okay? In June, which is this month, June is over, we had credit card and auto loan forbearances ending. They gave you 3 months saying, oh, I know things are hard. You may have lost your job. You may have be underemployed. We're not going to make you pay your credit cards back or your auto loans back for 3 months. Guess what? That's done as of 4 days from now. July 1st, you have state and local budgets are starting to implement cuts. On July 15th, you've got the delay in federal income tax payments that are due. So they're talking about pushing that off another delay. That's not out there. So July 15th, tax day, people. So if you have a nut to pay to the tax boy, that's coming on July 15th. On July 31st, you've got enhanced unemployment benefits are starting to roll off. On September 30th, we have student loan forbearance programs ending. On October 31st, we have mortgage forbearance programs are starting to roll off. And ending it up on December 31st, you've got the PPP grace period ends. That's what I call policy cliffs, okay? That's why I'm saying the worst is not over, okay? There are more challenges ahead. Volatility is going to remain elevated, and this period is going to be probably elongated as far as the potential impact from an economic standpoint. When you throw in a presidential election coming in November, in which right now you've got the incumbent trailing, President Trump is trailing Joe Biden. the markets are also looking at that because they're thinking, okay, if Biden wins, there's a lot of things that Trump has done that they are going to erase immediately. One is going to be tax cuts, okay? And which you go back to 2018 and 19, part of the stock market increases and in corporate earnings increases in 2018 and 2019 was due to tax reform. If they erase that, all that's going to do is elongate this recovery period, because that's going to pull more money out of the economy, more money out of people's pockets into the government's pockets, which needs it, to be candid, okay? You can't just give everything freaking away for free, and that's going to slow recovery, okay? So how do we handle this going forwards in an environment like this, or what I'm anticipating, which is stagflation? Number one, you still want to own high quality treasury, short term and intermediate. The long term, you can trade it. That's my job, not yours. Okay. Tips: treasury inflation protection notes. Tips tend to perform good when inflation is rising. As long as they continue to devalue the dollar or the dollar sinks relative to other foreign currencies, you're going to see tips be a good place to be. From a sector standpoint, things that historically, emphasis on historically, okay, have performed well: utilities, technology, REITs, and there's one more. I gotta find my cheat sheet here. I thought I had this down. And REITs, energy. Oh my gosh, how can I forget energy? Oil, gotta love that. So anyway, those are ways we're going to continue to combat it. So some things you are probably going to be seeing in your portfolios as we move forward are, we're going to own more things like that, okay? As volatility remains elevated or we see tougher days ahead, we're probably going to see less equity exposure and more bond exposure. We're going to continue to protect. So just prepare for that, okay? Don't freak out and go, oh my gosh, I hate bonds, and why do I own bonds? There is a purpose behind why we own bonds, okay? Safety, security, you guys should make money in bonds. You know, it's not just about the interest rate, which is crap right now. But anyway, it's all good. So many people, I tell you what, 1651, unreal. Oh, I didn't go 20 damn minutes. You got to love that. Anyway, hey, for Wall Street X's and O's for the week ending June 26th, this is Craig Modelmog. I love you guys. Keep hanging. Stay positive. Being positive is a decision you have to make every day, and you can do it. Is it hard? Yeah, it's a bitch someday, but you know what? Get up, put your pants on, and we're gonna have a good day. I love you guys. Again, June 26th, 2020, Craig Modelmog, Wall Street X's and O's, and I am out.